Hello there, everyone. Thank you so much for joining me. My name is Denise, and I'll be hosting our Scotia iTrade Market Insight session today. I am thrilled to be joined by someone who likely needs no introduction from many of you, Derek Holt, which is Vice President and Head of Capital Markets Economics at Scotiabank. Derek brings years of experience translating complex data into clear, actionable insights. If you've ever read his morning notes, you'll know that he has a sharp and direct voice when it comes to cutting through that noise and understanding the market scope. So today, helping us break 2026 down into different macro themes is Derek Holt. Welcome. Thank you so much for joining us. How are you doing today, Derek?
It's an absolute pleasure, Denise. Thank you. And I'm happy to be here with Scotia iTrade clients.
I just want to kick things off with a question about you, Derek. Before we dive in, I know many of our viewers probably know and have heard and followed your market insights and commentary. But for those of us who are kind of new to this type of scope, could you start by just sharing a little bit about your background, your approach to macro research, what you focus on when it comes to analyzing that big picture?
Yeah, sure. Okay, that sounds good, Denise. So I've been a practicing economist for 31 years. In this environment, another 31 years of practice might help. It's a very challenging environment, to say the least. 18 of those years have been with Scotiabank in a variety of roles throughout my career. And so there's been a few cycles in that period of time, and I've been fortunate enough to work for some very good employer like Scotia. And in the sense that it provides the resources and all the client exposure and opportunity to really delve into these things and try to work with our clients in making sense. And so over that period of time, it's mostly been a focus upon institutional clients, large corporates in the past 18 years, but we serve bank-wide. It's part of a diverse team in economics of a very strong team of professionals across a bunch of different areas. And so it's a good place to be in terms of trying to figure out the world.
Thank you so much for setting that tone for us. Let's start off by taking a look a little bit about the 2025, what's happened in the past. How would you characterize 2025 from a macroeconomic perspective?
It was interesting to say the least, but when you look back on it in retrospect, we got through it pretty decently. I mean, the U.S. stock market proceeded toward record highs. We performed quite well in Canada relative to the U.S., even in terms of the performance of the TSX market. We saw global equity perform pretty well. We saw the world economy post another year of just over 3% GDP growth in inflation-adjusted terms. China grew at about 5% in that context. We estimate that the United States grew probably somewhere on the order of about 2% or so, and the Canadian economy grew by about 1.5%. Some of those quarters were astounding for the U.S. economy, and it grew by about 4% in each of the second and third quarters. And so when you look back on it, starting with Inauguration Day in the United States and the introduction of a multiple variety of major policy risks that have been overhanging markets, the uncertainty it created so far, we've been able to keep it all together and keep on a relatively even keel. And a great example of that actually is the Canadian job market. There's been no other stronger job market in the world in the past 4 or 5 months or so. We've heaped on almost 200,000 jobs, despite tariffs, despite all of the uncertainty, despite the risks and all that. And so on balance, 2025 was a very stressful year, very exhausting for us and for many of our clients and people, but we got through it all right.
It was definitely an exciting one nonetheless. Were there any themes or turning points this year that you might have caught the market off guard?
Not all, but many people in the markets, when you go back to the US election, the November 5th of 2024, you had many people saying, well, the U.S. would only implement the good things, the deregulation and the tax cuts and some fiscal pump priming, and we'd get through it okay. It'd be wonderful for growth. And some of the bad things would be downplayed or not delivered upon. And that was probably where there was the bigger shock to markets and the bigger shock to the consensus of people across the whole street. That we saw tariffs. We saw massive tariffs being introduced. We saw marked change in immigration policy across a number of countries, including the US and Canada, significant tightening of those policies. We did see fiscal pump priming. We've seen limited deregulation in the markets, but it's been more of a balance, I would say, that's been confounding to central bankers and markets in terms of how to foresee developments on a go-forward basis, and what kind of a mixture of those policy risks that we are looking at now. But I'd say it was a bit of a reality check going back to the initial euphoria coming out of the stock market response to the U.S. election.
And we've definitely seen and heard a lot of debate last year when it comes to the terms of economic resilience versus slowdown. How did that narrative evolve in 2025?
So far, resilience. It's, I mean, it could have been better. It can always be better to economists, at least, and but not so much to markets. I mean, to look at it from a market standpoint, everything performed very, very well. We saw the cyber currencies perform reasonably well on balance. I mean, they've come off some of the froth, generally speaking. We've seen equities proceed to record highs. Credit relative to sovereign base yields tightened in, and so credit, corporate bonds and the like performed quite nicely. We saw currency volatility, substantial currency volatility, but in some respects that actually worked to our favor. In Canada, for example, as we saw tariffs being implemented, the Canadian dollar price of $1 went from about the low 120s just a few years ago to about the high 130s. So now costs you about $1.38, $1.39 Canadian to buy $1. That's a significant depreciation in the Canadian dollar. That's helped us adjust to some of the price shock of those tariffs. And so the other takeaway here, just quickly, is that the markets adapted to some of the bad stuff that we could have done without, in my opinion, some of the tariff uncertainty. And there were some offsetting market mechanisms to help us adjust along that path.
And just one last question before we start looking ahead. Did central banks land where the markets kind of expected by end of year, or was there some divergence from the earlier forecasts?
I'd say broadly speaking, yeah. I mean, we were coming off the initial spurt of post-pandemic inflation that unfolded coming out of the 2022 to 2024 period of time. We started to see greater progress toward disinflationary pressures for a time in 2025, and that allowed central banks around the world to continue their easing campaigns. And so the Fed proceeded. The Bank of Canada started in July of 2024 and kept cutting until March of last year, and then came off the sidelines to deliver another 50 points worth of cuts last fall. All because they felt that, okay, well, we're gaining that traction in terms of repairing the damage that the pandemic did to the balance of risks on inflation, which ultimately at the end of the day is their job, to control inflation. And so did economists and markets get the forecast perfectly? No. As a broad narrative, did they get the general thrust of things correctly? Some resilience, some ongoing performance of progress on inflation and central bank cuts? I'd say directionally, yes.
Okay, thank you so much for giving us that little bit of a rundown of our past. It was definitely a eventful year that happened in 2025. Lots of things that you've highlighted, we are definitely experiencing. I want to take a little turn and see where we're headed now. As we head into this new year, what's the tone in the market that you're seeing? Are we seeing any optimism? Is it caution, or is it something kind of in between?
I think it's important to inject a bit of caution in terms of not overreacting to the kind of market moves we see on. But to put things in perspective, we are seeing markets right now show some concern about the geopolitical risks in Greenland, Venezuela, the challenges facing the U.S.-European, U.S.-Canadian relationship, and how things might unfold, and whether we are dredging up tariff risks all over again, going back to last April, and how they unfolded over the summer. But when you sit back and look at it all, the US S&P 500 proceeded to an all-time record high, and we're only about 1.5% off of that all-time record high. Most economists wouldn't bother getting out of bed to evaluate the consequences of a 1.5% stock market correction. That's a flesh wound. So far, right now, you can't time these things. You can't really overreact to them in the shorter term. If people are in equities really for the right reasons, they have a longer term, medium to longer term perspective on things. And I think fundamentally at the end of the day, they don't want really destabilized markets. And so we need to look through some of the saber rattling that's going on and some of the tensions, and be observant, but also keep an eye on those longer term forces.
I agree. And when it comes to the equity markets, how would you say they digested that economic signals from the late 2025?
Well, with the same challenges that economists face, to be honest, it's a lot of the data is very murky, especially with as it surrounds the world's biggest economy, the United States. I flat out do not trust much of the data that they are producing right now, and that's not to impugn the professionalism and motives of necessarily of the people who are working at these agencies. They're very strong statisticians and professionals, but the shutdown and the firing of the BLS commissioner and the political infusion of risks into these organizations has clouded the playing field a little bit, and our ability to interpret what's going on. Data sampling rates have fallen. I'm not sure I believe the seasonal adjustment factors that are being applied to some of these things. They're substituting imperfect methods of collecting data because of draconian budget cuts at the data agencies in the US, and that's compromising a lot of the quality. But when you sit back again, and I'll keep making this point, and look at how the markets have gotten through it, the markets basically shrugged and said, yeah, okay, we're going to look at alternative forms of data. We're going to look at earnings. We're going to look at what is the broad tone for corporate health and overhanging the market. And they proceeded to new record highs in stock markets toward the end of the year and the start of this year until the past few days or so. And it's very premature to try to read from these signals, very, very latest signals, what's going on at this point in time.
Let's touch a little bit on inflation. What would you say is the latest story there? How are the markets reacting to that most recent inflation data? Is there any signals and signs of strictness? Do we happen to see any differences in inflation or expectations here, Derek?
Yeah, it's I mean, we're off the peak. We've made an enormous amount of progress compared to where we were in the last few years. That's the optimist hat.
Mm-hmm.
A bit more of the pessimist hat would say that it's still early innings, in my opinion. The pace of change that we've gone through across global trade channels and supply chains doesn't get evaluated with 1 or 2 months of inflation readings, or 3 or 6 months or 12 months of inflation data. And so I'm constantly, having this dialogue with our clients, with our traders, our trade floor, saying, yeah, I know you have to trade the latest inflation stats, but don't believe what you're trading too much. Because on a go-forward basis, it takes a long time for businesses to adapt to a change in the rules, to a change in the order. And tariffs are creating walls in parts of the world. They're diverting trade through different channels. It's creating the risk that you have to abandon legacy assets in jurisdictions that are no longer economical to produce and reinvent those supply chains somewhere else. And that means costs. That means hiring new people, striking new supplier relationships. It also means companies are being very guarded with respect to inventory management. So right now in Canada, we have the highest inventory relative to sales in the economy-wide sense since the early 1990s, roughly since I started my career. And that probably reflects in part the nervousness around whether or not supply chains will be disrupted again, and a willingness to pad those inventories so they don't run out of product all over again and have to hike prices dramatically. And we're seeing wage and cost pressures that are still significant, and metals and other commodity prices rising. That tends to be a precursor to broader inflation. These are forces that unfold, Denise, over years, not months.
For sure. And I just want to talk a little bit about fixed income and get your thoughts on that. What's happening on the fixed income side for us? How are yields closing out in the year? And what are some of those key drivers behind that?
We've got a bit of a reminder of one of the main catalysts behind the shape and level of global sovereign yield curves across the whole world. And we got that reminder out of Japan. They're faced with an election by February 8th. The Prime Minister thinks she can capitalize upon an early spurt of support after having become PM last October, and she's promising a lot of goodies in classic election pump priming fashion, like suspending taxes on food, for example, and offering targeted stimulus all over again. And so fiscal signals to the markets are such that all the bond market participants hear is more debt, more debt, more bond issuance, more bond issuance. That means more supply. That means you probably have to put upward pressure upon yields. And it's the same in the United States. It's the same in parts of Europe. I think it's to a lesser extent in Canada, where we have a better relative position, but we're not immune to these forces. And so the whole bond market has cheapened up pretty significantly. You have the US 10-year yield now at about 4.25%. Where our forecasts suggest that it could be 4.25, 4.5 as you go forward over the duration of the year. But there are very, very wide intervals around a forecast like that because policy is in flux.
Mhm. Now that we've looked at the past of 2025, we've taken a look at what's trending so far. Let's take a look at some of the forces that are shaping 2026. As we look into the months ahead, what would you say are some of those key macroeconomic themes or risks that are on top of your mind heading into the rest of 2026 for us?
Yeah, it's going to be a very eventful year, and not just because of the Olympics next month and the World Cup in the July that I'm also looking forward to. To add a bit of levity to things, very serious talk of economics, but it's I think some key things to keep an eye on are how much longer and further can the AI trade proceed. So far, it's been a lift to growth. Our
Mm,
estimates are that you get a positive effect on growth through the wealth effect, makes people feel richer in terms of what's going on with the Mag 7 stocks on a trend basis. And the impact upon the overall market, and they feel more confident to go out and spend. There's been a lot of investment in the AI space, an enormous amount of investment. In fact, it's the only thing holding up investment in the US economy. If you take out of the picture AI related and tech investment, the rest of the investment picture is contracting in the U.S. economy right now, which is quite unusual for where we are for the performance of the U.S. economy overall. So I think AI is a big question mark. I don't have the answer to what it's going to do to productivity over time. It might take years before we see it showing up in the data, which has been a lesson from the past. I think it's a productivity boon, but it's not something that you can react to on a month by month or quarter by quarter basis. It takes time. Trade negotiations are going to be very important. Right now, we're taking a step back at the start of the year.
mm,
Um, I think, don't hold me to this, but I think the closer you get to the midterm elections in the United States as another key catalyst on November 7th, it would be very unwise or imprudent for a US administration to create such uncertainty and to have a weakening stock market and the global economy in turmoil because of flaring tariff wars and tearing up trade agreements. I think there's going to be some sort of calming period as we get closer to that period of time as the year unfolds, but that's another key uncertainty,
mhm.
including what happens to our trade agreement with the United States. And I'm cautiously constructive on what happens in that sense. But politics and geopolitical factors, the historical tendency is markets tend to react to them in the short term, but they tend
Mhm.
to dissipate pretty quickly unless you're really, really, really encountering out of sample experiences. And I think it's highly premature to judge that right now.
What are your thoughts on the central bank's activity? Do you see that central banks remaining a major focus in 2026? Are we kind of likely to see a monetary policy fade a bit into the market influence? What's your thoughts on that?
I think global central banks, the big boys and girls of central
Mm,
banks, the biggest ones, are in a bit of a calming period of time. They're
mm,
either done cutting rates or close to being done cutting rates, if not contemplating future hikes, but well down the road and penciled in with emphasis upon penciled. I think the Fed, we have very tentatively coming back to cut again at the March FOMC, but a lot has to go right between now and then. We have 3 cuts this year from the Fed in our forecasts, at which point we think that they will be done. We have the Bank of Canada on hold straight through this year until late in the year when we, again, penciled in very tentatively, expect the next move to be up because of cost-induced pressures upon inflation. And so right now, I view the Canadian yield curve as relatively rich compared to how it may evolve going forward. The yields are relatively low compared to our expectations for where we go at the end of the year. The ECB, the ECB is signaling that it's done cutting rates. The Bank of England might have a little bit more easing to do. Some of the Scandies are signaling that they may be done or very close to being done, if not. And the Bank of Japan is going the other way because the prime minister is in an election mode, depending upon what happens, adding fiscal stimulus. And the Bank of Japan is likely to lean against some of that with further hikes this year. So you're seeing more variety across central banks, is the point, Denise, than what we saw in the past couple of years when many of them were easing, except the Bank of Japan.
I see. Thank you for that. This next question is going to be a little personal, but in terms of some indicators and data points, we'd love to get some thoughts on what you might be personally watching out for closely in Q1 to help us gauge how 2026 is starting off, any labor market earnings, wage growth. What are the themes that you're going to be keeping an eye out for?
Yeah, it's next week brings the Mag 7, a lot of them earnings reports in the US
Mm,
economy. I would watch the guidance coming out of them for capital plans, for the balance between staying on track with respect to heavy spending in the AI space,
mm,
the hundreds of billions of dollars that many of them are putting in, and over $1 trillion. But at the same time, perhaps shifting toward monetizing more of that spending and making sure that you get some profit out of it. And right now, the difficult thing to judge is where are we on that continuum in terms
mm,
of spending too little versus too much, and how much of this stuff can be monetized versus how much of it is just neat to do. Like it's neat if I'm in Houston or what have you, and I want to get the name of a good local restaurant, I can go to ChatGPT or some other AI platform, but nobody's charging me for that really. And you can do all sorts of Taylor rule and other economics, experiments in some of these platforms. But again, unless you really push the frontier and use it a lot, you're not paying for it, and you're only paying a nominal fee, even if you do wind up using it a lot. So how much of it is monetizable and truly going to bring out new products, new processes, lower costs? I think a lot of it, but we don't know where that balance sits relative to how richly things are valued right now. And that's going to be the single biggest question I find this year. Not
mm.
tariffs, not US elections, but the extent to which those types of companies in the US equity market in particular strike that balance on both of those counts.
And as we head into the new year, what's one thing you think investors may be underestimating or overlooking in this current environment? Is there any blind spots or themes that deserve a bit more attention from us?
That's a tricky one because it's kind of, to coin a former U.S. politician. I mean, they're the known unknowns and the unknown unknowns, and it's usually the black swan event is something that nobody's talking about. And so I throw that forward as a caution. But in terms of things that we can surmise or speculate toward, I think one big one is I've already covered AI, but another big one is on the trade side of the picture, the trade negotiations. I am glad most of your viewers are probably sitting down when I say this, but at the end of the day, I think there's too much pessimism, particularly applied to Canada. We've only had about a 6% tariff shock applied
Hmm.
against us by the United States. It used to be about 1% average effective tariff rate. Take out the most affected sectors, and like steel, aluminum, some of the non-trade agreement compliant forms of exports, and you cut that ratio, that tariff hit in half. And the Canadian dollar has depreciated by more than enough to accommodate that for the vast majority of exporters in the US. And so they've actually seen an improvement in their export competitiveness. At the same time, the US economy is still performing well. And so I kind of go back to a lot of the scary theories that people were advancing 2 or 3 years ago about how mortgage resets would derail the Canadian economy. Didn't happen. Delinquencies stayed low. People kept paying their mortgages on balance. Some people were very challenged, but it was a micro event, not a macro event. And I view tariffs so far in the Canadian context as being somewhat similar. I think it's more about fine tuning going forward. And you could see those cautious signs of optimism gradually creep back into the market in our forecast horizon.
To close off this chapter here, if you had to sum up the current macroeconomic situation in just one word or phrase, what would that be and why?
One word, I get paid by the word, right? In publications and speaking, but I'll try my best. It is an R word, but that R word is resilience.
Mm,
And I think there are many, many different forces in play here. It's important not to glom on to just one or two of them. There are a lot of moving parts, some more constructive, more favorable than others. But look at the broad, big picture sense as an investor in terms of where you see things going forward. Don't subscribe to unifactor theories of the universe about how trade is going to be the only thing that matters, for example, or AI will be the only thing. It'll be a blend of these things going forward. And it's important, I think, to take that medium, longer term resilient perspective.
Thank you, Derek, for the fantastic insights and the deep dive into where we've been and where we could go next. We hope we gave you a clear understanding of some of the forces shaping 2026. We encourage you to keep exploring, stay informed, and continue building that investor confidence. Thanks again, Derek, for spending that hour with us. I hope you enjoyed the session.